When things get bad in an economy, one thing almost always happens. Credit tightens up. It gets harder to take out loans and it gets more expensive to pay off the loans that you already have. We've seen it time and time again, and those of you watching who have lived through a few recessions will have no doubt seen it happen in real time. As all recessions vary in severity though, so do credit freezes. Back in 2008, when literal banks and financial titans like Bear Stearns and Lehman Brothers collapsed and other banks found themselves forced into awkward mergers or just bailed out by the taxpayers altogether, we saw the worst credit market in almost a century form, something that would go on to be known as the credit crunch. Now, in late 2022, warning signs are screaming that we might be about to enter another credit crunch, one that's maybe even worse than the one we saw just over a decade ago, and this is worrying to say the least. When credit dries up, our markets and economies essentially cease to function altogether. They are, simply put, not designed to work under these conditions, and so when worse comes to worse and this sort of credit environment emerges, bad things happen. In this video, I'm going to explain exactly what is going on, what it means for us all, and I'll be showing you the data that proves it all as well. Really quickly, I want to give a quick shout out to the Daily Upside for partnering with us on this video. Check out the link in the description to sign up for their free daily newsletter. For us to truly establish everything we want to though, we first need to know what exactly a credit crunch is, and in short, it's a sudden reduction in the availability of credit, of loans or debt. Essentially, it gets far harder to acquire loans, and in conjunction with that, it also gets far more expensive, and we usually see mass defaults of loans that already exist as well. Needless to say, it's not something anyone wants to see, especially in 2022 when inflation is sky high and many feel that investing through debt is the only way to come out on top. We do now need to establish just how likely a credit crunch really is though, and unfortunately, from my point of view, it's almost inevitable at this point. If we look back to the credit crunch that happened along with the 2008 global financial crisis, we see one very overwhelming trend that brought it all on. There had been years of incredibly loose monetary policy and incredibly lax lending standards that led to a massive debt bubble as people, businesses, institutions, and even charities took out huge amounts of debt because it was so easy and cheap to acquire. That time around, most of the debt that caused the credit crunch was focused on property or the real estate markets, as you no doubt well know. A booming housing market had drawn millions of people who really had no business investing in property at all into calling themselves landlords, who were able to derive a profit from their holdings only because the debt that held everything together was so cheap and easy to find. When the housing market started to wobble, it instantly became clear that none of this was sustainable, and this debt bubble eventually hit a tipping point which brought it all crumbling down. The assets which were supposed to back this up were nowhere near as valuable as underwriters had hoped, and the people who owed this debt suddenly saw all of their assets dry up, so there was, simply put, no recourse for the loan givers who were left out of pocket for billions of dollars. This story we hear about almost every week at this rate, but what we usually don't hear about is what this did to the debt markets at the time. Banks had literally run out of money, and even worse than that, they owed billions of dollars out to other financial institutions and our governments. They simply couldn't give out loans even when they wanted to. Say you were a very well-paid person on a salary of $300,000 to $400,000 a year and you wanted to buy a home for $700,000 with a 25% down payment, something you could quite easily, frankly, afford. Well, you would have seriously struggled to find a bank to actually give you any of that money at the time. Say you wanted to get a new credit card or even just increase your credit limit. Well, even if you were the ideal customer, you've been paying off debt reliably and consistently for years and have a near perfect credit score, the bank simply couldn't give you that extra credit, even if they wanted to, because they didn't have the reserves to back it up. Need a new car and don't quite have the money to buy it all in cash? Well, tough luck. Run a successful business that wants to invest a bit of money into growth with an incredibly solid and reliable business plan? No chance at all. Want to take some cash out of your home in a refinance to build an extension? Well, better luck next time, mate. Credit well and truly just dried up, and there was nothing you could do about it, and sadly, we're heading right back in that same direction today. Now, before we get on with the rest of the video, let me quickly tell you about this video's sponsor, The Daily Upside. It's gotten pretty hard to find unbiased yet insightful news sources these days, especially in the finance or investing niche, but thankfully, The Daily Upside is here to solve that problem. It's a free daily financial newsletter written by a team of financial experts who are unhappy with the state of the media, and it's currently read by 800,000 investors every single day. They focus on explaining the most important news that every investor needs to know, and they also go in depth on specific pieces every week. Just last week, they published this piece revealing how Japan spent over $40 billion in just 1 month trying to protect its currency. No matter who you are or how sophisticated an investor you are, The Daily Upside is a great source of unbiased financial news that can help cut away the chaff and keep you up to date. It is totally free with just one email sent out to you every morning, and personally, I've been reading it for about a year now. So if you want to be better clued up on the markets tomorrow, then sign up to The Daily Upside today using the link down below in the description. Now think back to a few minutes ago and remember when I explained the reason for the last credit crunch in the first place. Years of loose monetary policy and easy to acquire debt that led to a massive bubble across the economy. Does that sound at all familiar? Well, it should, because it is exactly what happened over the last few years as well. I know I don't need to explain to you that the 0% interest rates we had for years made the debt the cheapest it has ever been in history, and I know I also don't need to explain that the loans given out post the COVID pandemic were done with almost criminal nonchalance. That debt bubble exists right now, and it's been growing for years, just as we saw in the 2000s. Back then, the trigger for the collapse that led to the credit crunch was the housing market falling, but this time around, it's likely to be the collapse of just asset prices across the entire board. Indices are now down by 20 to 30% for 2022. Home prices are starting to waver as well, car prices are crashing too, and even alternative assets are often getting hammered. Every piece of margin debt that exists in this economy that people have been using to invest, or more often than that, gamble on the stock market, is slowly being retracted from the economy as asset prices fall, and the banks are booking losses here. The real estate investors who should have never been real estate investors will also start to lose money as house prices fall, and the banks will try to recover all their capital, but that will merely force prices lower and exacerbate the problem, and they will book losses. Car prices are already getting smashed every single month, and they have a long way to fall, as much as 50% down from here on out in many cases, and already most people are actually underwater on their car loans, which means when the bank seize your car or your truck to try and pay off the loan that you stop making repayments on, well, the bank won't be able to get all their cash out. Those who are foolish enough to buy a $20,000 or $30,000 Rolex on finance because Rolexes only go up in value, bro, will soon enough find themselves out of work as the recession kicks in, and when they go to sell their vanity piece in order to pay off their loan, they will quickly find out that the watch simply isn't worth what it used to be worth. Banks and financial institutions will be forced to book losses, some will take hits to their profits, some will go bankrupt and be bailed out by the taxpayer, but some will just be allowed to shrivel up and die. But in the wake of all of this, a new credit crunch will emerge, whereby it is nearly impossible to get any kind of debt, no matter what the purpose or how reliable and trustworthy the applicant, and this will have drastic consequences. Now, some people will think this really isn't a big deal, the idea that it will just be harder for us to get debt, that credit cards will become more difficult to acquire, and car loans given out less freely. On the surface, you would be right, it's not the end of the world. But it does pretty much doom our economies to periods of stagnation or even decline, because our growth for decades has been predicated on debt, and when that debt dries up, so will the growth. We've been growing our GDPs at 2 or 3% a year, despite the fact that our population has not been growing at that rate, and neither has our productivity or our salaries. The difference is being made up by debt. We take out debt to fund our creeping lifestyles. We can't actually afford the cars we buy today, so we pull that wealth in from the future by borrowing money and paying it off over time. Without this ability to steal from our future selves, the 90% of people who buy iPhones and do it over a 24-month plan will no longer be able to do so. The 90% of people who buy cars and do it on a 4-year plan will simply not be able to, and our consumer spending will dry up. Businesses will see their earnings decrease as their customers no longer have access to free money, and this will ripple out across the rest of the economy. To make matters worse, entrepreneurship, the #1 driving force of wealth in human history, will suffer greatly as well. It is notoriously driven by debt, with the vast majority of businesses financing their growth through debt, and as we saw post the financial crisis, that access to credit and capital dried up, and so innovation suffered. This will all happen again, and it will make the coming recession so much worse. Now, I know what some people will say to all of this. They claim that either this isn't going to happen at all, or if it does, it will be years away, so nothing to worry about. But unfortunately, that just isn't the case. The data is now here to prove it as well. Car loans are already starting to see significant problems emerge, with people defaulting on car loans more and more every month. This data comes from Cox Automotive, who track car loans across the US every single week, and it is not good. Delinquencies rose over the last month by 2.6%, and compared to the same period last year, they're up by 30.8%. Delinquencies are now at the highest rate we've seen since January 2010, right after the 2008 financial crisis, and it should be clear that we are heading in that same direction. For severe delinquencies, the data is looking even worse, with it being the highest we've seen since early 2006, over 16 years ago. At the same time as people are failing to repay their cars at the worst rates we've seen in years, new car loans are getting more and more expensive, and the average interest rate for an auto loan increased by 1.1% over the last month alone. Banks are already starting to institute this credit crunch in the market, and this is before we even get close to a breaking point. For housing or mortgages, the exact same story is being told. For this, we have something called the Mortgage Credit Availability Index, which measures how easy or difficult it is to get a mortgage in the US, and the data is released every month. Over the last month alone, the index fell by 5.4%, which is the 7th consecutive fall, and that brings us to the lowest level we've seen since March 2013, when the housing market was still shaken and recovering from the housing market crash. It is right now harder to buy a home and get a mortgage than it was during the worst possible days of the COVID pandemic, when every business in the world was shut down and no one knew what was going to happen next. To make matters worse, this index is falling rapidly, and it's only going to keep going down as interest rates continue to rise at the same time as people get poorer in real terms. Let's not forget that just earlier this week, the Federal Reserve raised interest rates by another 75 basis points, or 0.75%. Once again, this evidence proves that we are entering the next credit crunch right now as we speak. Banks see the writing on the wall, and they are already tightening the market because they know mass defaults are coming, and this will have monstrous consequences for us and the entire economy. But what can we actually do about it all? Well, we can do the exact same thing that we always should be doing. We should be sensible. We shouldn't take out debt that we can't afford. We should make sure that we have enough cash to tide us over should worst come to worst. And we also shouldn't rely on a credit card to survive if we can. We should live within our means, as we should have been doing for decades now. And the chances are that in the end, if you do this, everything will pass for you. Finally, just before I sign off here, I'd like to give one last thank you to the Daily Upside for making this video possible. Make sure to go and check them out using the link down below in the description.